Hi, I'm Dominic Picardo here for the September edition of Spreadbet magazine, and today I'm chirping about Songbird, the somewhat naffily named company that owns more than two-thirds of the Canary Wharf Group, landlord of the famous towers and a shopping complex down below. Now, real estate in London is absolutely booming right now, especially in the residential sector. Price and value actually seem to have gotten completely disconnected, what with all the foreign money gushing into the market. But part of the reason that housing in the capital is so buoyant is because of the strength of the financial sector. Exactly the sort of companies that occupy Songbird's offices in Canary Wharf. But unlike the housing market, commercial property like offices and retail space in the capital isn't ridiculously overblown right now. Demand for office space and shops is very healthy, and as a result, commercial property values are also on the up as well as residential values. So, in the case of Songbird, its net asset value per share rose from £1.90 to £2.10 in its last financial year. So per share, that £2.10 is what its net assets are valued at. And net asset value is of course the key metric for valuing real estate companies. And ideally, what we want to do is to buy a share like this at a decent discount to NAV. In the case of Songbird, the share price is just below 152p right now. So, with a historic NAV of £2.10, we've got a discount here to NAV of about 28%, which is reasonably good. I mean, sometimes these companies approach parity, and sometimes they can even trade at a premium to net asset value. So here we've got a decent little discount here, and this discount is one reason why I think the share price may have further to run, even though it has already enjoyed this terrific run-up since the lows of last summer around 100p. It bottomed twice at 100p, and since then it's up around more than 50% or so. But I think this could have further to run, and what attracts me to this specific uptrend is the structure of it. You've got this nice steady pattern where you have a gain in the share, where you have a run up in the share price, and then the price has entered these sideways corrective phases where it's sort of consolidated its gains here, and then before breaking out to the upside. And a sideways period of consolidation is exactly what we seem to have been experiencing here over the last couple of months or so. And the share price, as you can see, has been well underpinned by this 55-day exponential moving average, the line you can see here, which provides a nice sort of floor to the share price lately. So what I would be expecting here is for once again the share price to break out of this range, just like it did here, and head on upwards. And that could be on the way now, because you can see here that the range in recent days or in recent sessions has been tightening, and that is often a precursor to a breakout. When you get less volatile periods like this, or periods of declining volatility, it often presages a big breakout to the upside. So, what sort of targets would be looking for when this occurs? I think we'd be looking for in the first place a move to 171p, then 185p, and then possibly more.